Hi everyone, welcome back to Toronto Money Basics with me, Pam. If you're new here, I explain financial topics in simple plain English that make sense for life here in Toronto and across Ontario. Today we're talking about something that confuses a lot of people, segregated funds, and specifically the principal guarantees that make them different from regular investments. If you've ever wondered, what does a 75% or 100% guarantee actually mean? Or is my money really protected? Or even, this sounds too good to be true, what's the catch? This video is going to clear it all up. Let's start with the basics. A segregated fund, or seg fund, is an investment product offered by insurance companies. It invests your money in market-based funds, similar to mutual bonds or ETFs, but it also comes with certain protections because it's an insurance contract. And because it's insurance, seg funds fall under FSRA here in Ontario, which is the Financial Services Regulatory Authority of Ontario. Not the same rules as banks or regular investment accounts. Now, the feature everyone hears about is the principal guarantee, that 75% or 100% protection. Let's break that down in the simplest way possible. What does a principal guarantee mean? A principal guarantee protects all or part of the money you put in during two specific moments: at maturity, for example after 10 years, and at death. That's it. Not daily, not weekly, not whenever the market drops, just at those 2 points. Most insurance companies offer one of these: 75% guarantee. It protects 75% of your original deposits, or 100% guarantee, which protects all of your original deposits. So if the market is down at maturity or death, the guarantee kicks in and brings your value back up to that protected amount. Let me give you a super simple example. If you invest $10,000 into a seg fund with a 100% guarantee, and after 10 years the market is down and your fund is worth $7,500 instead, the insurance company tops it back up to $10,000. If you had the 75% guarantee, they'd only top it to $7,500. That's the core idea. It protects your original deposits at specific times, not your day-to-day market value. Some seg funds offer something called a reset. A reset lets you lock in a new, higher guaranteed amount when markets go up. Here's how that works. If your $10,000 grows to $12,000, a reset lets you raise the floor. So now the insurance company guarantees $12,000 at maturity or death, not the original $10,000. This can be helpful if markets rise over time and you want to predict the progress. But keep in mind, resets can restart your maturity period, depending on your contract. Not all funds offer them, and not all funds offer unlimited resets, so you may be limited to how many times you can take advantage of this. This is why reading the insurer brochure or asking a licensed advisor is really important. Now, this is the part that's really important, the trade-offs. The guarantee is not free. Seg funds often come with higher fees than ETFs or simple index funds. You're paying for the insurance protection. Here are the trade-offs in simple terms. The pros: 75 or 100% of your principal is protected at maturity or death. Potential resets if available, bypass probate on death, potential creditor protection in certain situations. The trade-offs: higher fees because it's insurance, guarantees apply only at maturity and death, not a short-term product, limited flexibility depending on the contract. It's not good or bad, it's just tool versus purpose. If the protections matter to you, the higher cost might make sense. If the protections don't matter to you, then it may not be the right fit. So why do some people choose seg funds? Here's what I see in Toronto and Ontario. People look at seg funds when they want growth with a safety net, peace of mind for their beneficiaries, when they want to avoid probate delays, or they want some level of creditor protection or protection for their deposits at maturity. For example, someone close to retirement who wants growth but fears a market drop, or a business owner who wants a potential creditor protection, or maybe parents leaving funds to their children and wanting a smooth transfer. Really, anyone who wants the mix of investing and insurance guarantees? Seg funds are not for everyone, but these are the situations where people tend to find value in the guarantee. So let's summarize. Seg funds give you a 75% or 100% guarantee at maturity or death. Possible resets, insurance benefits you don't get with regular investments, but in return you pay higher fees and you need to commit to the long term. If you found this helpful, hit like and subscribe for more simple, Ontario-friendly financial education. And let me know in the comments, had you heard of seg funds before this video, or is this your first time learning about them?